Hi, welcome to Fortunato and Friends. I'm doing the introductions today, so bear with me. Thanks for coming on the show. Thanks for taking time to listen in. We have Laura Gamble on. She's a old friend and a great guest. This is her third time, which I think sets a record for guests on the show. About a few months ago, maybe 3 or 4 months ago, I was like, "Hey, who are we gonna get on the show?" And I was like, we haven't had Laura on in a while. Let's get her back, and she was kind enough to join us. And then we had a banking crisis, so it's a crazy coincidence that we have her on here to discuss it. So we'd love to have you on. Thank you very much, Laura. It's great to see you again and have you on the show again. And since the last time we got together, I just wanted to thank you for your commitment to carbon-free energy. And Constellation and PNC are working on sustainability goals and clean air and healthy lifestyle by signing the deal for carbon-free energy. So thank you very much.
Well, thanks for having me on for my third time. I was sort of expecting I got a little crown or something for being here.
What are they doing Saturday Night Live? They give you a jacket. Maybe we'll give you a crown next time you come on.
Yeah.
But yeah, so I'm just surprised you can even have the time to come on the show, given everything that's going on in the banking industry lately. Have you been under the hammer of the Fed, or are you guys doing okay?
This week's actually relatively calm. I think things have eased pretty much. But no, we've been we're doing well. I think we're one of the larger banks that are really have been sort of the beneficiaries of the crisis, right? In the sense of people moving money and flight to safety. So that really hasn't been a challenge for us, but it makes people nervous, and we spend a lot of time talking to customers and making sure that people understand what's going on and who's been impacted, and the fact that at PNC that we weren't impacted. And one of the things that we've been talking to people about, which only comes out at a banking crisis, which is are my deposits insured? And at PNC, like most commercial banks, the vast majority, 46% of our deposits are insured by the FDIC, because our average depositor has around $21,000 with the bank. So,
and what's the FDIC limit, Laura?
$250,000.
Okay, so there's a nice headroom there.
Yeah, but, based on this is something that people always ask in a crisis, but it's based on account ownership. So if you are a single account holder, add up all your accounts at one institution, and up to $250,000 in your name is insured. Now, if you have other accounts that are owned differently, like a joint account or a business account, that's a separate category, and that total starts on that separate category.
Okay, good. So let me ask you. You mentioned the FDIC, and I want to talk to you about that in a minute. But if Janet Yellen comes out and says, "Hey, we're going to insure all the customers of a bank for whatever they have in the bank," is that a handout, or is that just insurance?
It's insurance. It's the banks pay into that. So, essentially it would be a charge coming back to the member banks of the FDIC.
And it comes out of my interest rate, right?
Sorry?
It comes out of my interest rate. So it's if I was getting 5%, I get 4.75, and that quarter of a point goes to the FDIC.
Yeah, essentially it's, you're going to end up, the consumer's going to end up paying for it.
Okay, so my thought is, like, I can go lose money on cryptocurrencies or commodities or stocks anywhere easily, right? The banks are kind of bashing the stability. They hold my cash for a rainy day. They hold your payroll. They hold just cash that needs to be done. I just don't think there should be any risk in that. And if I was diligent, say I was a billionaire, right? I wouldn't be on the show if I was a billionaire, but if I was a billionaire at 250,000 limit, I can go to 4,000 banks and put 250,000 in and be totally covered anyway. So like there are ways around that limit, and like instead of being so cumbersome, why don't you just make it more efficient and just give everybody unlimited insurance on that? What do you think about that?
Well, I don't know. I personally, I always feel that, you can't make everything perfectly safe for everybody, right?
Right.
Um, and essentially, one of the biggest caveats in business is without risk, there's no reward, right? I don't think you can make anything completely risk-free. That's except, the treasury bill, right? And you and I could argue that maybe there is a little risk to that as well, right? But,
Sure.
I think making sure that the banking system is safe for the average person is really kind of the mandate of the FDIC insurance. It's really not about protecting everybody, but it's making sure that the average depositor is safe.
Okay. What about the average businessman who has a payroll in your bank, right? And I do, I don't know, $1 million a month. So I need, a couple $1 million in my bank account. Should they be safe too, or is that kind of over the top?
I mean, they are insured up to 250,000 as well by entity. So, they participate in that as well. And I would say that, if you are, paying attention to who you do business with, I think that you're going to be fine. I don't think we've, short of the Great Depression, when, these were all measures that were put into place after, the crash of 29 and the Great Depression, where nobody had any insurance, right?
Right.
So all this has taken place since then. And I think it's worked fairly well, right? I mean, I don't think that we've had huge catastrophic losses in the banking system since then.
No, I don't think many people have lost it all. So, okay, good. So how's your life change? You're a bunch of people with, you don't recognize in strange looking suits kind of run around your bank and call the Fed and looking around at any problems? Has your stock is really just kind of moseyed along while most of the bank stocks have gotten hammered. Has your bank's life changed?
No, I mean, it's so funny. I mean, actually, the day of, the quote crisis with SVB, we had some analysts in from, banking analysts, and they actually wrote that, you couldn't tell that anything was going on based on what was going on in our offices and our headquarters in Pittsburgh. It was just another day. And,
Okay.
it has really not, um, made that much difference. That we've had, a couple of bank analysts actually put buys out on, buy recommendations on our stock that week. So there's really, we are, a nationally chartered bank. Our regulators are the Office of the Comptroller of the Currency and the Federal Reserve.
Hmm.
So we're under pretty, strict supervision all the time, and we, adhere to all the regulatory requirements and the stress testing and, all the ratios that we have to meet on a quarterly basis and more frequently in some cases. So, I don't think for us that this has really caused, much to be different. And we're actually, a company that does really well in the downturn. Not that we've experienced one, but we all seem to think that there's one, about to happen, in a couple quarters, that we're going to have, negative GDP at some point in this year. And we are a pretty conservatively managed bank, and we tend to have some of our best opportunities in the downturns. In 2020, we bought BBVA, which was the domestic operation of a Spanish bank, and it helped to, fill out our footprint across the Southwest and the West Coast. And who knows? Maybe there'll be another opportunity like that for us, down the road if if there's continuing, instability in the bank in the small to mid-sized banks.
So just I have two very basic questions of banking. The first one is, how did your bank in particular, how does it make money? Like you turn your lights on every day, you open up your branches. What happens to?
Well, really, essentially, we make money by lending money, right? That's the primary function, that we, by which we make money. If we lend money out, basically we take in deposits. The old model was you took in a deposit and then you lend it out. Took a deposit at 3%, lend it at 6%, and made 3%. Although the old adage was deposits at 3%, lend it out at 6%, and on the golf course by 3 p.m. But that. But then, now we obviously pay, we pay interest on deposits, and we earn interest on loans. We also do a whole lot of other things that banks, didn't do 50, 60 years ago. We, sell interest rate derivatives, and we manage money for people, and we have a lot of financial technology under the treasury management side of the business, where we help people manage their working capital, and along with a lot of data and managing data around their finances. So those are more fee-based businesses. So that's part of what we do. So we're not all just interest earning. We also have some pretty large fee-based businesses as well.
Very awesome. So, and now the other basic question is, give me a synopsis of what happened during this latest banking crisis. Like, what everybody's going along, putting money in a bank, taking money out of the bank, and all of a sudden the headline kind of snaps in, banks fail, and everyone's kind of panicked over the weekends. And so what's going on when that happens? Tell me what happened.
Well, honestly, it was a good old fashioned panic. And you may have heard that term used really going back to 1929 when the stock market crashed and people were lined up at banks, wanting their money. The fundamental behind this is that no bank, if every depositor, I don't care if you're talking, the biggest bank in the US or the biggest global bank, if every depositor showed up on their doorstep that day and demanded to have all their money out, they could not meet that. No one has all that on cash on hand at any given time. Because as I just explained, basically, we lend out a lot of that money. So,
and about 75% of your dollar, 75 cents on a dollar, goes to loans and the rest go to reserves, right?
Right. And, while we keep a lot of reserves at the Fed and we have cash on hand, you couldn't satisfy every single depositor. And that's every bank. That's just really kind of how the basic banking model works. So, when somebody starts what we call a run on the bank or a panic where everybody's like, oh my God, I have to have my money now, no one could really satisfy that. And that's really what you had at, at SVB and at Signature, where, they had runs on the bank. People got nervous. They wanted their money, and they, went and encouraged people to move money as quickly as they could. One of the differences between now and even, the financial crisis back in 2008 is the proliferation of people being able to move their money instantaneously with their phone. You don't need to call anybody. You don't need to show up at the bank. You can just wire your money out, or move it to another account electronically. And that, I think that, sped everything up to a point that we just hadn't seen before.
Almost like a Reddit kind of run.
Yeah. I was going to say that it's like we went from the bank run of It's a Wonderful Life, everybody run to George Bailey's bank, to now what Twitter said, bank run, where people are seeing posts and then deciding they're going to move their money online, and you can move $13 billion a day out of SVB.
Yeah. Instantaneously, practically. And so that, it really, that's how it really started. People getting nervous, and, and it's a self-fulfilling prophecy to a certain extent. Now, there were other things about SVB in terms of their business model, how they manage their balance sheet, that, that also, exacerbated that. If you think, I think of it a little bit like the S&L crisis, which I always think of as being in the late 70s, but I actually looked it up recently, and some people said it happened in 80, some people said it happened in 83, but I sort of thought it happened a little earlier. But you had a similar situation.
It went
from
on for a while.
For what?
It went on for a while though.
Yeah,
Yeah.
yeah.
You
I
had the
just
Keating 5 scandal. You had a whole bunch of stuff. Yeah.
right, and I just for my memory, I thought it was over a little earlier than it was. But the essentially, similar balance sheet issues brought on by an inflationary situation and the Fed raising rates really quickly, very high, very fast, which stressed out the balance sheets of these S&Ls. And it was further complicated by the fact that they the amount that they could charge on deposits was federally controlled.
Yeah.
So that they had nowhere to go, right? Their costs are rising quickly, and what they can charge is held steady, and of course that just caused a lot of pressure. So I think of that similarly in the situation we're in now, right? Inflationary pressures, Fed for 15 years of nearly zero interest rates is raising rates really quickly to try to get a hold on inflation, and it's causing major stress to balance sheets of banks.
Yeah. So before you mentioned S&L or savings and loans. What's the difference between a savings and loan and a bank? Like your PNC Bank is a bank, right? What's an S&L?
Well, a lot of them were they were basically they were founded to help promote home ownership. So most of them, their real mission was to make mortgage loans, right? Take deposits, make mortgage loans. And they had a separate regulator. So it was, a different charter, very different business model. Little concentrated, right? If it's all, if most of your assets are in mortgage, residential mortgage loans as opposed to businesses, small businesses, consumer loans, of other things. So it was a very focused business model, and that after that crisis, they collapsed the federal regulator that they were under, brought it under the Office of Thrift Supervision, which, if I remember correctly, during the 2008 crisis got folded into the Federal Reserve.
Yes, it did. Yeah. Now we're deep in the weeds. Let's have Keith pull us out of the weeds a little bit here. Thanks, Laura.
I'm going to mute myself. That would help. I did have one question, banking question for you, Laura. Check. One person asked, when will the Fed allow banks to clear checks in minutes instead of days?
Yeah, well, that's, blockchain essentially, right? Instantaneous technology. The Fed is working on, I think they have a new payment system that's just getting ready to be launched fairly soon. Fed Now, I think it's called. But essentially, it's not really the Fed, to be honest, that keeps you from being able to clear immediately. It's really, most banks don't clear through the Fed, the big ones anymore. Some portion of their items may go through the Fed, but essentially they go direct to other banks and clear directly.
When you use like Zelle, like I use the app Zelle, that goes bank to bank transfer, right? Yeah.
Yeah. Well, it's funny.
It's essentially like a clearinghouse. And the banks all formed various clearinghouses to exchange items way back when, literally they'd be in the parking lot of the Fed and they'd all drive up and they'd like be passing bundles of checks back and forth in the old days.
But I was a bank teller in college, since you guys are talking about it, but it used to be 5 business days for an in-state check and 10 business days for an out-of-state check. So things have gotten way better since I was a kid.
Well, yeah, because literally you had to physically transport that item from one end of the country to the other. Now it's all done electronically, and that actually largely happened, as we'll like talk about in the weeds banking lesson, that happened post 9/11. Because during 9/11, if you guys remember, planes were grounded for quite some time.
Yeah, they
And
were.
that practically seized up the banking system because they couldn't exchange those physical checks and items. And they realized, okay, we need to have a different mode of doing this. And then it went to basically, optical exchange of
Right. Okay. Take a picture. Yeah.
Yeah.
All right. We have a poll question here. Let's just. All right. Launch is here. Okay. Before the banking crisis, did you know what percentage of deposits are insured? People want to answer that. Yeah. We've got that one, and we have another poll question if we can launch two as well. Laura, while we're letting people answer this, do you think you were saying, the Fed stimulus, the low interest rates? Do you think that this is SVB? If the Fed, raises another half a basis point, do we see other banks come under stress, or have a lot of the problems been, probably the problem banks been identified already?
Yeah, I think that the action that the Fed took, they in addition to the Fed window, which banks, can borrow at, they instituted a separate facility for banks to come and borrow from. And last week or a week before, I saw that that facility was being used by banks more than going to the straight Fed window. So that seems to have helped a lot. I think that's taken a lot of the pressure off. And the interesting thing about that facility is, which I think is a good thing, you don't know who's utilizing it because they won't publish who went to that facility to borrow until I think March of 25. So it's all kind of, under the radar. So it doesn't discourage, banks from going and using it if they need it, which is good.
Which is, they've always had those lending facilities, but it's like a red mark on you if you've used them in the past.
Yes. Right. Yeah.
Yeah.
So this helps, I think, a lot.
Okay.
All right. I'll share the results here. 67, 2/3 said they did know what percent of their deposits were insured, and 1/3 said no. So,
yeah. Well, I guess, a lot of people, if you went through the 2008 crisis, people were looking at it then as well. So I think that's part of it. And also, you've got a fairly, more highly educated group of people here than probably, if you took somebody off the street and asked them that question.
Right.
Here's another trivia. You might remember this, Ed. When did it get raised to 250,000?
Oh, it went from 100,000 to 250 back in, I think, the crisis of 08, wasn't it?
That's right.
And it was originally $1,000, the FDIC insurance.
Yeah. And before it was 100, the crisis prior to that, it was 40. It got raised from 40 to 100.
Yeah, that's kind of crazy, right? It's and like you don't think about this because it's a given, but when someone would rob the bank in town, the town's money would be gone, right? And like, so now they're just kind of sitting there going, what do we do? Or if they robbed the stagecoach, or back in the day, like it was primitive until 1932. It was like literally putting him under your mattress was as good a shot as the bank, right? And that's what it had those big safes displayed on the floor because this safe is invincible. Like it was primitive.
It out as banks were a safe place to put not just your money but your valuables, right? Safe deposit.
Safe deposit box, yeah.
That was the primary value proposition, which is supposedly it was safer than under your mattress.
Yeah, it was. So who knows? It still feels. I just remember like when I was a kid, like my Italian relatives would be like, it's in a coffee can in a paper bag in the backyard.
Right.
And when Uncle Mo would die, you'd grab a shovel, and be like, let me start digging up the backyard. There's money out there. So it's kind of wild. What role did crypto play in this?
Sort of a very, I think, minor role from my perspective. So we talked about Silicon Valley Bank. That was the one that, it had the panic and sort of started things. Signature Bank, a New York-based bank, I guess New York and California, had tried to carve out a business proposition of banking the crypto companies. And they had suffered, some losses around that. Well, people, not so much, losing money on crypto investing, but the businesses who were crypto businesses going out of business hurt them. And I had some impact on, the resulting sort of run on their deposit base. And then the regulators in New York just, sort of proactively took them over.
Yeah. Well, I told you this, I'll share with the audience, but I went back to Staten Island to see my brother for the holidays, and there was a Signature Bank right by his house. And it's a nice area, but it's kind of gritty. It's got a car wash next door. It's got a car dealership on the other side. It's got a supermarket. And it was this beautiful, elegant Signature Bank. And I'm like, what are these guys doing here? Like, what they don't belong. And I went this week, I looked up and looked at it, and there's basically a sheet, a bed sheet, kind of covering the Signature name with, FVB, I think First Valley Bank took it over or something like that. And, complete with the elastic around the edges. So it was it got really kind of simple very quickly. So
well, this is saying that in bank acquisitions, the only people who really win are the sign makers.
Yeah, sure. Yeah, because everything's the same. The people, the tellers and everything like that are the same. But what's happening to it?
Just the new sign outside of the bank.
Yeah, I know Congress is exploring this, and they're usually a little bit behind the 8 ball as far as timing and stuff goes. But how do you avoid another run like this?
Well, for me, those banks had very sort of limited business models, right? I think the average, I think they are outliers. The average commercial bank in the U.S. does business with, a lot of different types of businesses and consumers, and they aren't concentrated in one industry or one product type, which both of those banks had issues with. For instance,
so maybe you can use an example of your bank. We'll use your bank, and like you said Signature was kind of getting into the crypto market and stuff like that, and some little real estate. But like, does your bank have a concentration? Are you loan manufacturer, an oil company? Like, what are you all over the place? What is it?
Yeah, we really aren't concentrated because, frankly, the number one rule of risk management is diversification. So, you're actively managing your businesses, your line of businesses, your loan portfolio to make sure you're not overly concentrated. I mean, some of the previous downturns in the past, I think particularly in Maryland, 1991 was a real estate related crisis where Maryland National Bank came within a day of failing because they were overly concentrated in commercial real estate, and the real estate recession, all of a sudden you had all these see-through buildings all over the mid-Atlantic, nobody could pay. So managing for lack of concentration is really, your number one rule of risk management.
Okay.
And something like 80% of SVB's business was in the tech industry. So, the tech industry gets a cold, they got pneumonia.
Right. So like, all right, let me go back to my younger days. But if you were gambling, if you were running gambling, if someone came in and wanted the Chiefs way too much and it was bigger than your ability, you'd go call your buddy up who has a bigger book or go to Vegas and lay off that risk. Yeah. Can banks do that?
Well, I mean, I think
they go to Uncle Warren or somebody like that, or say, let me sell you some loans, or
they do. I mean, you can syndicate loans, which is what most banks have what we call house limits. So you by based on your size and regulation, there is a maximum loan limit that you can make. But most banks don't go all the way up to that limit for every customer, right? So you do syndicate things, you do lay off the risk on, and manage it amongst other banks. You can sell loan portfolio, right? You can definitely, manage risk that way. Sort of like reinsurance, but not quite, but that similarly. So, it's really it is managing risk. It's managing, concentrations. It's managing, what's going on in certain industries at, any given time. The other unusual thing about Silicon Valley Bank is not just that it was very concentrated on the tech industry, but so much on venture and private equity funded companies, which is really unusual. For most commercial banks are cash flow lenders. So you have to demonstrate that you've got the cash flow and, over a period of time, usually like 3 years or more, that you could pay back this loan we're going to make you. If you're pre-revenue or just barely, making money, and you've got a huge amount of private equity that's funding you, generally they're using that cash that they've got set aside to secure a loan to them, right? They're not doing it on cash flow basis. So that's a very different business model, and they would take equity upside, which most commercial bank lending situations you don't do that.
Okay, yeah, because they don't take a piece of the action.
Right. I mean, the thing about banking is our upside is extremely limited, right? The downside is you don't get paid back. The upside is you may make a few points of interest. It's not.
So I've always thought that the grease that oils the wheels of capitalism is lending, right? Like you making loans. Is that analogy that you just made the flaw in the system of capitalism, where you can lose 100 cents in a dollar, and the best you can make is 3-4 cents on a dollar in a year? And is that why the government is so involved in this?
It's a great question. I don't think it's a flaw in the system as much as there are lenders at every, sort of all along the, the business line here, sort of you've got your really sort of high rate short-term lenders, like your payday lenders. You've got commercial banks, you've got private equity, there's a ton of private lending going on, with businesses in the US and globally that, that's relatively, I'd say within the last 15 years, a relatively new thing, right? Where people are investing in loan funds. You've got, family offices making loans. And it really was all, I think, in a very low interest rate period away, people were seeking yield, right? So they're jumping into these, these lending arrangements to make some yield.
And risk was all tamped down because the yield was so low, right? Like people didn't care.
Well, and people may be taking more risks than they realized, for, just a little extra yield. I mean, that's another thing in the balance sheet management conundrum. I was saying, with rising interest rates, a lot of the banks, especially SVB, had invested in treasuries, but had gone out the yield curve, just trying to get that little extra bit of yield. But they were locked in, and when they needed cash, they had to sell the portfolio at a $2 billion loss.
Yeah. The stat that did it for me, what I found interesting was that of the IPOs in like 2021, SVB got like 40% of that, or a very large share, and they didn't have that many loans to make, so they put it into long-dated treasuries, and then the Fed raised rates, and they were underwater.
Yeah, and and I think obviously if you can hold those to maturity, you'll be fine. But they didn't, because they had to run and they needed the liquidity.
And that's why the Fed came out and said they'd lend on those things, 200 cents on a dollar, right, to kind of take that interest rate risk out of there.
Yeah. So yeah, it's there are lenders at sort of every point in the business arena, right? There's all types of lenders. And I do think, I mean, it is, I think, capitalism definitely, we would not have the amount of business or GDP that we have without someone who's willing to lend money, right? I mean, because you just can't get as much done if you're a business, if you don't have the, if you don't have the cash and there's nowhere to go, to get that piece of equipment that you need or that building you need to take that next step. So it definitely.
Yeah, let me ask, before Keith, you come in and ask some questions, but what happens like before private equity? Would the bank do that lending? Did they stop do that lending? Did they take that risk away? How did private equity get so large so fast in that?
Well, I'm not so sure, and I'm going out over my skis here. I'm not so sure that it really took business away from the banks as much as it's lessened the IPO market, right?
Okay, that's a great answer. Yeah.
I think, that when you're looking at capital and who's the provider of capital, banks really, aren't your primary provider of equity capital, right? So I think that that's just really shifted from, from the IPO market and, more over to private equity.
All right. Thank you. You must be a pretty good skier. Since you must be a pretty good skier since you were over your skis. And you answered that so well. So I was like, okay, you're good.
You'll have to find the facts to back me up on that. But that's what my gut tells me.
But it makes sense though. Like think about what private equity does, right? Like they take so many companies private. They have this lot of money. They overpay for a lot of things that, most investment bankers would never do business on. So they are more aggressive than a bank or even a Wall Street firm.
Yeah, well, at times it makes it very hard for the strategic buyer because it's harder for them to compete for, for a company that, would be a good addition to their firm because there's so much private equity out there chasing a yield that it tends to push the prices up.
Yeah, that's a great call. Keith, what do you got? What do you got for us? Turn your.
There we go. Sorry about that. We have 2 questions. The Fed, so one question is related to the Fed's level of interest rates, and where does the Fed go from here? Should the Fed not allow interest rates to fall below 3%? Maybe maintain a real interest rate. To prevent what's been living through, a past financial crisis. What's the lowest interest percentage or benchmark rate to avoid other financial problems and inflation? What are your thoughts on that? Where does the Fed go from here?
I think we already saw that they slowed down a little bit, but not much. Instead of a 50 BIP,
right, they did 25.
They did 25. I actually thought maybe they wouldn't go at all, but
me too. That was my guess.
I was kind of surprised that they went with the 25. I think that to me that indicates they're not gonna step aside. They're gonna keep moving rates up because they can't get control of inflation. And the Fed operates under the dual mandate, 2% inflation and low unemployment, and the unemployment has been low for the last since we came out of the first 6 months of the pandemic, pretty much, right? And even participation is coming back. So that that's you can't really ask for more than that, but the inflationary pressure keeps going. And I think they're personally, is 2% inflation the right number? I don't know. I think what people look at though, is there anything that's really structurally changed that you could point to say that 2% is no longer the right number? And I don't think they've been able to really say that there's anything structurally different. And therefore, I'm not sure they're willing to make that change, that anybody is willing to do that.
Could the big difference between our relationship with China and our access to cheap goods there, we all through the last 20 years, we've been, having low inflation, and, Alan Greenspan and Janet Yellen all kind of scratch their heads. And could it be the animosity of China kind of limiting us in our abilities to supply chains?
Well, possibly that, and they have they've had a, huge demand for our debt, and, would take as much debt as we would issue too. So, if those things both stopped, that could be really, problematic for us. But yeah, the U.S. has, an insatiable demand for cheap goods. I don't know what makes that change. Do you all of a sudden, have this, sort of, buy American at any cost kind of, throwback? I don't know.
Yeah. And we don't even make it, frankly, right? Like,
in a lot of cases, no. but there is that, like the desire to produce chips on American soil, more, sort of from a, I don't know, sort of a defensive,
Yeah.
What's the word I'm looking for? Sort of a, American protectionist kind
protection, yeah. And not protectionism for the trade, but more protectionism for our access to it.
Yeah.
Yeah. It's interesting. My thought has always been, we produce so much money in this country, like through the stock market, right? We have a $40 trillion market. So, I have this, money in my account, and, Apple doubled or tripled or whatever it did. And now I can, instead of buying a Chevy, I can go buy a Mercedes. And like I go out there and the balance of trade gets all messed up, and, I'm subsidizing the rest of the world because, I want the fine leather in my car or something like that. It's just, we're too big for ourselves sometimes.
Yeah. And, I think I still go back to, even though most of the supply chain issues have improved, I think when we get a few more years past this, looking back at going, we shut world trade off. It went to zero. And then we started it back up. What's the, are there longer term issues relative to that, other than, yes, we realized that, just in time is not always, the best way to move goods.
Yeah, it's far from perfect.
And the dependency on China for manufacturing. A lot of companies are dependent on China, and that a longer term risk now there. Yeah. That there wasn't maybe before.
And having backup supply, everyone's got to build that into their processes now, and there are costs associated with that. So that does, that may account for some of the inflationary pressures, right? But I don't think it's.
Yeah. Well, just with things like, I just remember going to my dad, asked me $20 to buy a pair of jeans in high school. And I was not a fashion plate then. I am not a fashion plate now. And like, you can buy Costco jeans for $14 a pair now. That's, 40 years later. It's like, how does this happen?
Right. Yeah, but meanwhile, what's a carton of eggs cost now? It's over $6, right?
Yeah, it truly is. Yeah. Eggs are like handing out money now. It's like currency.
Yeah, exactly. Start a side hustle selling eggs.
Yeah, go get some chickens in my backyard.
We had one question here. So I guess if you say brick and mortar banking question, with the advent of electronic banking, why are so many new brick and mortar branches being built? Is that people are coming in for financial services more? Is that where the industry is going?
It's a really, really good question. What we have seen, prior, I go back 10, to right out of the crisis, essentially, like 10, 11, you started to see a real acceleration in, mobile banking, online banking. It had been out there for years, but then we started to see higher adoption rates. The pandemic, pushed that to whole new levels. Not just on the consumer side, but really the business side. A lot of the ones that have been holding out, who'd been writing payroll checks by hand, realized that they had to go to, alternate methods. So, what we see that, really overtaking, in the people coming in for transactional purposes into the bank. what people come into the branch for, usually now it's they can't open an account online, but they'd rather open in person. They may have a problem that they want to sit down and talk to a person about, but the transaction volume is so far down. So, what I think, I can only speak from our, side, we think that, branches will still exist, far fewer numbers, but what you do at one is going to be vastly different than what you did at it 20 years ago. You're not going to go in to cash a check. You're going to going in because you're talking to somebody you need, to, close on your mortgage, whatever, right? And that we're seeing currently.
Okay, all right. We have one question here, and it's clarifying about FDIC insurance. The 250K insures savings, checking, money market, what's in your name, right? And then it doesn't cover mutual fund. Combining question, mutual funds are at-risk investments. That's your Fidelity, Vanguard.
Yeah.
Your Merrill Lynch, or yeah.
Right. If it's a securities, if it's a securities market instrument, that is separate. And if you through a broker, your broker may have something called SIPC, which is a separate kind of insurance. But I'm not as clear as to what that would cover on that side.
Okay. And then one question here was, should the banking community themselves try to better regulate or more frequent stress tests? What do you think is going to come out of this? There's always the concern about too big to fail. But is there going to be a whole new review now of that? Do you see that? Is that going to raise costs? Is that going to move money from small banks to bigger banks now over time?
Well, we did see a little bit of that, frankly, in this past crisis. I think, there's definitely already talk in Congress and in the, the finance and banking committees about, reviewing, are we, regulated under the right things? The CFPB also, I think, has inquiry going around. It would not surprise me if there isn't some, new legislative action around the stress. But, we get tested a ton. I'm not sure, and I would really like to see what, what comes out of these inquiries, because, I don't think that anything that we're currently tested on would necessarily have raised any issues with these banks other than ones that have already been raised, because the Fed had already made several comments and had many conversations with management at SVB. I think, that they were aware that there were issues, and I think that will come out. You'll hear more and more about what kind of criticisms they had made. I'm not sure, all of these, anytime you stress test, anytime you go through any of these, regulatory tests, it's backward looking, right?
Right, you're looking at the results, not the what led to it. You gotta go through.
I don't know that you could get, unless you're doing real time, information. I don't know that you can really get at it through, testing and, regulatory ratios and that sort of thing. I mean, I think that they're going to just have to look at the oversight.
Okay, all right.
Hey, Keith, before you wrap up with questions, I have two more for Laura, and it has to do with economics.
Go ahead. Why don't you ask one? Ask them on that. Go ahead, Ed.
Thanks, Keith. And then, well, this banking crisis increase the chance of recession? Is it? I know the Fed's goal was a soft landing. Does this increase the chance of a hard landing? Are we in a hard landing? Is the crisis going to continue? Like, is something going to pop up in 3 weekends and be like, oh my God? I know the Bloomberg headline this morning said banking crisis should be over.
Yeah, it's a very good question. I don't think the banking crisis itself necessarily, sends you into, recession. I mean, for me, my personal opinion is recessions are consumer confidence driven, right? So if it's big enough, like the financial crisis in '08, there were businesses, failing, all, big businesses needing bailouts, every time you turned around. That drove confidence to zero, right? I mean, I think that accelerated everything. I don't really hear that right now from people. I don't really hear that people have lost, faith in the U.S. economy, or that they think this is going to overtake, the economy. And, as we were talking before, there are certain companies that are still doing quite well.
Yeah.
I think we anticipate that this earnings season, that we are seeing, some slowdowns with, corporate earnings, and it's margin pressures, right? I mean, we're talking, things are inflationary. They're having to pay more for things. So their margins are getting pushed, a little bit. So we're seeing that, but we haven't seen sort of that, not yet that large, consumer lack of, people are spending money.
Yeah, they still have it. Yeah.
And employment is still pretty robust, right? So I think, I'm not sure what has to happen for, for all those things to just stop and send us. So I think we're, from our view, we think there's going to be a shallow recession later in the year, but it's going to be, we're not expecting, a major drop.
Okay. More of a normal recession, not a total crisis like we saw in 0809.
Yeah, that's kind of, and like I said, it's really, we're looking at earnings, we're looking at margins, and from that perspective.
Okay. Keith, back to work.
Sure. We have one question here. How close are we to a digital dollar, do you think?
Wow, that's a great question. Probably not that. My personal opinion, I don't think we're that far away. I think we're seeing people, more sort of willing to use digital wallets, and we went fairly. There's still cash being used, but boy, post-pandemic, it's at much lower rates than it was prior to that. So, people are already used to, payments, electronic payments. What's the next step, right? Just not ever actually seeing the currency associated with it. What will that happen in the next, 5 years, 10 years? I don't know, but I think that, better or worse, crypto has kind of introduced the topic. Blockchain has started to introduce the topic. I think the question is how do you do that and give the consumer, with confidence, where people have confidence that, that it's going to end up in their account, and that, that it's actually there and has some value behind it.
Okay. One follow-up question about crypto. The Wall Street Journal headline today said, "Oh, Bitcoin hits $30,000 first time since June on expectation Fed will cut interest rates." Well, I mean, if you run the regional board of the Fed, I mean, the Fed's going to be looking at the overall health of the economy, and what do you think the Fed's going to be looking at in the next couple of months here going forward, for the next meeting and a couple of meetings?
I think it's all about inflation, right? They really are trying to figure out how they can get control of inflation, and it's so far been, I think it's you saw some, it's slowly coming down, right? But the Fed's tools are not subtle; they're blunt instruments, right? So it's like using a, I don't know what, like an axe to cut a piece of paper, right? And there's not, once you get that ginned up, it's not like you can stop it on a dime, or hit that number right on the head. So I think they're going to just continue to try to work all the tools to get inflation down, and that means you might overrun it, and it means slowing things down a little too much.
Yeah.
But that's, I'm not on the board anymore, so I'm not, opining anything.
Right. Yeah. No.
That's just my, my guess as to, just based on what they've been, what their behavior has been so far. And I do think that you're going to see, because the other stuff outcome of, these two banks that we were talking about is, I think you're going to see them take a much greater interest in sort of, financial technology and regulating, crypto, they've been talking about that for a while, but I think they're going to start to take a little more interest in, those things that have not prior to now been under their purview.
And that'll naturally slow things down. Yeah. I have this hypothesis in my head that oil equals inflation. And higher oil prices go, the more inflation is prevalent. And, the Fed comes in with their blunt instrument, like you said. And, with this, peace treaty between Saudi and Iran, with the Chinese and Russia jumping on board and cutting production, that can make us quite vulnerable to inflation, regardless of what the Fed does.
Yeah.
Do you agree with that, or?
I do. I mean, I think, we are still very oil dependent, obviously. And, the supply is not in our control. So, we have to deal with whatever the outcome of that is. I mean, I think, we're trying to diversify our energy policy, but that's not a quick thing.
No.
So I think you're right. I think we are vulnerable in that regard.
Yeah, we are.
Someone who grew up like in the energy crisis, I mean, that's always kind of, always sitting right there.
Yeah, sitting in line waiting for gasoline as a kid.
Yep. Yeah. Odd and even days. Yeah.
Yep. Oh yeah. Remember that. Keith, last question. We got 2 minutes left.
We have one here. If the FDIC takes over a bank, now what happens to your money? Your account is insured, right? A new bank comes over, PNC or another bank would take over, and your deposit levels are maintained, insured by that insurance, right? The insurance pays out that your insurance levels are maintained, your bank levels, what's in your account is there, basically.
Yeah. And actually, if anybody did have money at any of either of those banks, you can literally go to the FDIC's website and they will tell you, what happened and, what you need to do. They've got, FAQs out there for people. But, if you had an account at Signature and it's now, open under a different name, SVB is now owned by First Citizens Bank. You should be able to walk in there and, they'll tell you, what's going on. It really, for most, the people who lost in all this were the debt holders and the equity holders. They're the ones that have, have nothing, essentially.
As they should, right? They take the risk. They should bear the brunt of it. Yeah.
No reward without taking risk. And but they got wiped out.
Yeah, they were. All right. Well, Laura, thank you so much.
Well,
Next time you're on, we get you a crown. We promise you, at least Sarah. And
I have to say, I always feel a little bit like I'm a little bit on like finance Jeopardy. So that, but I didn't have to, wager and write down that last question, which is a good thing, because whenever I play it, watching it on TV, I always lose at that point.
I'll take bank failures for 100, Laura. But yeah, no, thank you. It's been great. It was a great coincidence to have you on. It was perfectly timed. We always appreciate you having on the show. So thank you very much. Keith did a great job today.
Thank you. Thank you, Laura. Always great conversation.
Yeah, it's fun.
And if you want to hear more from me and Keith and Greg and Brian and Britt, next Wednesday we'll be on with a CMG call. And Fortune Island Friends is coming back in May with the chief economist at the conference board. So please look out for that, and we look forward to seeing you next month. So with that, take care, everybody. Thanks again, and keep your money in the FDIC.
Thanks, guys.
Thanks, Laura.
Bye now.